Right now, Bloom Energy, ticker symbol BE, is trading at $89.74, down 0.61% in today's session. The stock opened higher this morning, touching a high of $95.69 before pulling back, showcasing the kind of volatility that has become its signature. Many traders see this and think it's just another turbulent day for a high-beta clean energy play. But what if today's intraday swing isn't random noise? What if it's the early tremor of a fundamental narrative shift, a signal that the market is finally waking up to a reality that has been hiding in plain sight, far beyond the simplistic green energy label? The expectation has been that Bloom is a story of slow, subsidy-dependent growth. The reality is that the artificial intelligence power crunch has arrived, and it has positioned Bloom Energy not as a speculative bet on a distant green future, but as a critical infrastructure provider for the here and now. This changes everything. The common belief surrounding Bloom Energy is that its fate is inextricably tied to the whims of government policy and the gradual, often politically charged, transition to renewables. Investors group it with solar and wind, assuming its growth curve will be similarly choppy and dependent on tax credits and mandates. They watch interest rate fluctuations and legislative debates, believing these are the primary drivers for the stock. This leads many to use basic portfolio tools, perhaps even a standard robo-advisor like you might find with Schwab Intelligent Portfolios, to get exposure to the clean energy sector, lumping Bloom in with the rest. The reality, however, is far more specific and urgent. Bloom's solid oxide fuel cells offer something that solar and wind cannot: reliable, 24/7 on-site power. And right now, no one needs that more than the burgeoning artificial intelligence industry and its massive, power-hungry data centers. This isn't just about being green, it's about grid independence and operational certainty in an era where the grid itself is becoming the bottleneck. The recent surge in trading volume, with nearly 7 million shares changing hands already today, isn't just retail speculation you'd see on a Robinhood stock trading app. It reflects a deeper institutional realization. Large players using sophisticated platforms like interactive brokers are beginning to price in a new, accelerated demand curve driven by AI's insatiable energy needs. Let's dissect the recent stock movement with this new lens. The run-up to its 52-week high wasn't just broad market momentum that lifted names like Tesla stock or Nvidia stock. It was fueled by a series of announcements and realizations. When Bloom secured a massive project to power an AI data center in Wyoming, it wasn't just another contract. It was a proof of concept for a multi-billion-dollar addressable market that most analysts hadn't fully modeled. While many investors were focused on their Fidelity investments and diversifying with Fidelity ETFs, the smart money was connecting the dots between Nvidia's GPU sales and the consequential power demand. Every new AI chip sold is a potential future customer for Bloom Energy. This dynamic is causing significant institutional reevaluation. We're seeing hedge funds and asset managers who might typically focus on blue chips like Apple stock or broad market mutual funds, now dedicating serious research to ancillary infrastructure plays like Bloom. Their online investment strategies are evolving beyond simple tech exposure to the entire ecosystem supporting it, and Bloom is at the heart of the energy component. This is why the stock can swing nearly 10% from its intraday high to its low. It's a battleground between the old narrative of a subsidy-reliant manufacturer and the new reality of a mission-critical AI enabler. This isn't a stock for passive self-investing. It requires active attention to these shifting dynamics. Platforms like the SoFi investing app make it accessible, but the underlying analysis is complex. The company itself, Bloom Energy, designs, manufactures, and installs solid oxide fuel cell systems. Think of them as Bloom boxes, on-site power generators that convert natural gas, biogas, or hydrogen into electricity through a highly efficient non-combustion electrochemical process. This process produces significantly lower carbon emissions than traditional grid power and, crucially, operates independently of the grid. For years, their primary customers were commercial and industrial facilities that required uninterrupted power, like hospitals and manufacturing plants. Their business model was a steady but somewhat predictable enterprise. However, the technology's core value proposition, reliability, has found its killer application in the AI revolution. Data centers powering large language models and other AI applications cannot afford downtime. A grid failure that might be an inconvenience for a retail store is a catastrophic event for a data center, costing millions. This is where Bloom's reality shatters expectations. Past earnings reports showed consistent revenue growth, but profitability was elusive, a key concern for anyone managing their finances through a Fidelity brokerage account or looking at Fidelity mutual funds. But the most recent quarters have shown a marked improvement in gross margins and a narrowing of operating losses, signs that the company is achieving scale just as its primary market is set for explosive growth. The recent deal with Oracle to provide power to one of its data centers within 90 days underscores this new velocity. In the world of energy infrastructure, that is an incredibly rapid deployment, a key competitive advantage. So, what is the future outlook? The disconnect between expectation and reality presents a massive opportunity, but it is not with significant risk. The primary catalyst is the continued exponential growth in demand for data center power. Every forecast for AI adoption implicitly contains a forecast for massive energy consumption. This positions Bloom to capture a wave of demand that the traditional utility infrastructure is ill-equipped to handle. Building new power plants and transmission lines takes years, if not decades. Bloom can deploy its servers in a matter of months. Furthermore, as the world moves toward the hydrogen economy, Bloom's technology is dual use. Their fuel cells can run on hydrogen today, and their solid oxide platform can also be run in reverse as a highly efficient electrolyzer to produce clean hydrogen. This creates a long-term growth vector that transcends even the current AI boom. Savvy investors are using their individual brokerage accounts, whether with Fidelity, SoFi Invest, or Interactive Brokers, to build positions in anticipation of this dual-front growth story. However, the risks are substantial. Competition is intensifying, with other companies in the fuel cell and distributed generation space vying for the same contracts. The company's reliance on natural gas as a primary fuel source in many current installations remains a point of contention for ESG-focused investors, even though the emissions profile is better than the grid average. More importantly, Bloom Energy must execute flawlessly. Scaling up to meet this sudden surge in demand is a massive operational challenge. Any misstep, any delay in a major project could severely punish the stock, which trades at a high valuation reflecting these future growth expectations. The stock's beta is high, meaning it will remain volatile, and macroeconomic headwinds like high interest rates can make financing large projects more expensive. Comment below with your thoughts. Do you believe the AI-driven power demand will be enough to overcome the execution risks Bloom Energy faces over the next 2 years? Let's get a discussion going. This isn't a simple buy or sell. It is a complex thesis that requires constant monitoring of both the AI sector and the energy markets. In summary, the narrative around Bloom Energy is undergoing a profound transformation. The market's expectation was that of a niche clean energy company navigating a slow, policy-driven path. The emerging reality is that Bloom is a key solutions provider for one of the most significant technological shifts of our lifetime, the artificial intelligence revolution. The stock's recent volatility is a direct reflection of this tug-of-war between the old story and the new undeniable demand. While past performance and profitability concerns created a ceiling of skepticism, the future outlook, powered by the urgent needs of data centers, presents a compelling, high-stakes scenario. The risks of competition and operational execution are real and cannot be ignored. But for those who can see beyond the surface-level categorization and understand the critical problem Bloom Energy solves, the divergence between perception and reality represents the very essence of a compelling market opportunity.